passive is not so passive anymore. And you took the reins in 2008, and what we've seen from 2008 until today was this massive shift from active towards passive management, to the point where those who are big in the passive space, in the index space, Vanguard, BlackRock, State Street, which they call the big three, are the three biggest investors in most companies across the S&P 500. So you've seen that transformation. Could you talk about the growth of indexing and low-cost investing?
Yeah. So look, I think it's been a phenomenon that, in a sense, we've been waiting for a long time. We started the first index mutual fund in 1976. And we're pretty much derided in the industry for creating it. Everybody said, why would anybody want to be average? Why would anybody want to just be the benchmark? And it didn't really go anywhere for the first 20 years, and then the idea began to take hold. I think there are two sort of key data points, if you will, that have driven the growth of indexing. And the data points are when you look at net performance, and if you're a retail investor, net performance after tax, so call that one sort of set of data. And then the second one is a reaffirmation of a study that Brinson and Associates did in the mid-'80s. So I'll start with that one. If you're not familiar with it, Brinson, a bunch of guys in Chicago, looked at the attribution of investment performance. And what they discovered was that anywhere from 85 to 90% of a portfolio's performance is due to the asset allocation, not the individual fund or security selection. And so, the Brinson's point was, why are you spending so much time trying to find the one fund that outperforms or the one stock? You got to get your asset allocation right. And then the second element of that, of course, is that when you actually look at fund performance, over the last decade, but we've done this over rolling 10 years for the last 25 years. An index fund beats a traditional active fund, beats 90% of traditional active funds, and the number goes up to like 95% on an after-tax basis. So it becomes those two elements. Eventually, investors have begun to embrace.
Something happened in the middle 2000s, I think, back in my career, where Vanguard really found its voice. Can you talk about what clicked there?
What we found was there was this absolute mammoth gap, if you will, in what mutual fund companies in general were doing, and we in particular were doing in terms of just our portfolio companies had no idea where we stood on particular issues. They would only hear from us in the middle of a nasty proxy fight. And we just decided that we had to change that dialogue. And I think a lot of it really was driven by this notion that there was way too much short-termism in the marketplace. But if you're an index shareholder, in particular, an index fund holder, you're a permanent shareholder in whatever companies are in your benchmark. So, let's just use the S&P 500 as the simplest one. In our index trust fund, those 500 companies, we have to own them. We have to own them in the right proportion, and how closely we track is...
They can't just do the Wall Street walk.
We can't.
Right?
So if you don't like what's going on in the company, you have no way out, in a sense. You can't sell the stock. And if somebody comes in and tries to do something to one of those companies that you think is overly short-term oriented, on behalf of your investors, I believe you have a fiduciary responsibility to stand up and say, wait a minute, that's not in the long-term interests of our investors. Maybe it's in your interest, but it's not in the interest of our investors, and there needs to be a dialogue about this. You have a lot of people out there lamenting the rise of short-termism and the lack of accountability, if you will, in boards and so forth. And I think what we're trying to do is strike the right balance there in holding people accountable, but also thinking long-term as opposed to short-term.